Listen up. If you currently bank with a non-traditional bank, I need you to listen up so you don't become one of the 100,000 Americans who currently have no access to their life savings. Here's the thing. The same technology that has made banking seamless and made managing our money seamless is the same technology putting us at risk of losing our money. Here's how it's going down. There are a lot of startups that mean well, the objectives are great and would make life amazing for us, but they are not banks. They offer banking services or financial services. And so we, the everyday folk, the average Joe, think they are banks because we can deposit money and cash out money and transfer money and pay bills with it. We assume they are banks. And because we assume they are banks, we think they are regulated or as regulated as banks. Keynote, I am just a regular person on YouTube. What do I know? I'm just telling you what I know. I am not an expert. I have no expertise. However, since I am one of those who encourage online banking and encourage not online banking, but several online banks, and also encourage you finding ways to make savings seamless, I feel like I have to sound the alarm and let you know about this. So these companies, these startups known as fintechs, they offer these amazing services that we need and love, but they are not a bank. To become a bank takes time and it's expensive, takes a lot of money. They're just startups. But they know the only way they can get your business is to offer you banking services, the ability to store your money with them, savings, or have a check-in that you could use to do whatever you need to do. But they're startups. So what do? They partner with a bank. So the front facing company to you is, let's just pick a name, I don't know, Stove. You're thinking Stove is a bank because they have offered you 5% interest, much more than traditional banks, right? And you're going, "Oh, well, I'm putting my money there." But what you don't know or may not know is that Stove actually partners with, I'm just going to pick a bank, Chase Bank. So Stove is not a bank, not regulated as a bank. Their objective is to offer you this amazing service of giving you 5% interest on your savings. But they need to have a place for you to park that money. And so they partner with Chase Bank to provide the depositing and the bank account and the checking account while they handle what their startup is all about, which is the 5% interest and whatever else they do with that, right? We're keeping it surface level, right? Survey is not regulated like Chase Bank is because it's not a bank. So here's the thing. Here's where you come in or where you need to make sure you've done due diligence. I need you to go to your bank, whatever bank it is that you use, because you may or may not know the difference between the traditional bank and the non-traditional bank, the traditional bank and fintech, because to you it's all a bank. So if you do not bank with brick and mortar bank, i.e. the OGs, the Chase Bank, the Bank of America, the Wells Fargo. Mind you, there are several other brick and mortar, a lot of federal credit unions, a lot of smaller banks. I'm just calling the big names that we know, right? If you do not bank with them, I want you at some point between now and some point log on and verify two things. One, that it's FDIC insured or the equivalent for credit union. I never remember it offhand. I'll have it on the screen. Make sure it is FDIC insured. But because I already see you rolling your eyes going, yeah, I know, I already checked it. It's FDIC insured. Ma'am, sir, you have to go the extra mile. You have to make sure that the bank you are depositing your money to or with, the bank you are servicing, what you are having the banking service with, is FDIC insured. Using the example we used earlier, I need to make sure that when I go to Stove, Stove says Stove is FDIC insured, not that Stove is partnered with Chase, who is FDIC insured. Now, once again, I am not an expert. I have no professional backing to tell you, hey, what I'm saying is all that. So, therefore, you may be okay with the fact that Stove is in partnership with Chase and Chase is FDIC insured, and that's fine. At least you're informed and you're not surprised, right? That's the point of the video. As long as you're informed, whatever you do with that information, it is up to you. right? So I want you to log on to your bank, to whatever app you use, verify in simple English, in clear English, that it says the bank you were doing service with is FDIC insured. I'm going to use an example to show you what I mean. Sophie, Sophia, it's an online bank. We're going to use that as an example. I'll put it on the screen. They're offering a high yield savings account of X percent, as you can see. Now, it says as FDIC insured. What I'm asking you to do today, watching this video, or between today and sometime, is to confirm that this FDIC insurance is really FDIC insurance. How else can I say it? So I've read that, and it's telling me it's FDIC insured all the way up to what, 2 million? Obviously, I screen recorded before doing this, so I may not remember every single detail. It says up to 2 million, but I also see there are asterisks on there. And so I need to know what this asterisk is. You cannot take at face value FDIC insured because we all know, unfortunately, with the way things are these days, you can't just trust any kind of thing, right? All right, so if you keep scrolling all the way down, it's always all the way to the bottom, then you would see that it says the FDIC insurance is for the max of 250, but SoFi has its own sort of insurance system. That's how I understood it. I may be wrong, so you read it and you figure it out how you understand it, right? Now, knowing this, it is up to you. If you have more than 250,000, now you can make an informed decision. If you want to go with the Sophie plan for over 250, or if you would rather split your money around across 5 different banks so you're under that 250 cap. But if you take a look at that FDIC insured part, if you take a look at the verbiage, it clearly states the online deposits are deposited with Sophie Bank NA, Sophie or SoFi National Bank, and they are FDIC insured. Because it is one and the same, personally, I'm okay with this. But if we were to go back to the original example, if we're talking Stove and Chase, Stove is telling me what I deposited with them is going to Chase, and Chase is FDIC insured, but not Stove. I would not be comfortable with that. Here's how you can double check for yourself, not just based on that logo that you see on the website. You have access to the tax, what your taxes have been paid for. You go to fdic.gov, take a look at the steps I'm going through because now I can't remember detail, but on the search bar, simple the search bar, type in FDIC list. That's how I do it. Now, there may be another more straightforward way or more fancy way. Maybe there's a tab for you to do this. This is how I did mine. It's very straightforward. On their FDIC list, click on that and then type in the name of the bank you're interested in. So now I'm not going based on what they show me on their site. I'm going to the main guy, FDIC, to say, hey, do you know these people? Will you protect my money? So if we use Sophie or SoFi, the example we just used earlier, and you type that in, this was when I learned SoFi had a brick and mortar store. I had no idea. But on there, the very first one you can see is for SoFi National Bank. Now I know for sure, not because Sophie or SoFi told me, but because the main guy, FDIC, told me that yes, they got my back for $250,000. And so now I know whatever I put in SoFi as of today, things can change. And so if you watch this video a year from now, hey, do your due diligence. It's covered by FDIC insurance. So you do your due diligence. If you do not use traditional banks, most traditional banks, the brick and mortars, most of them are fully insured. Most of them, it's like the basics of the traditional, but it never hurts to check. If you're not using one of the big names, if you're using one of those smaller banks, it never hurts to check. And remember, when they offer products other than the traditional checking and savings, those products may not be insured. It is your due diligence to confirm that the new product is insured. And when I say product, I'm talking financial products. Some banks may have a brokerage account. Let's use that as an example. Your brokerage account is the account you use for your investments, right? A lot of those are not, I don't even think any of them are FDIC insured because you can lose money. It's an investment. Let me know. Do you know of any that is FDIC insured? Because my understanding is none of it is. It's a brokerage account. Now, if I open a brokerage account with, let's say, for instance, Chase, right? I know Chase is a major bank; they're FDIC insured, and I assume because it is Chase, that brokerage account is FDIC insured. Wrong, because it isn't. I didn't check to see if they are, but my guess is 100% brokerage account is not in FDIC insured. But now you're thinking because you saw FDIC insured on their website, now everything is FDIC insured. And I can guarantee you that when Chase offered you the brokerage account, it said on there in the fine print, this account is not FDIC insured. So we also need to take responsibility. That's the whole point of this video, is not even take responsibility because it's the right thing to do. No, because it's your money you're about to lose. So you should make sure you know where your money is going. Here's a story behind this video, true life story. In May this year, 100,000 Americans lost access to their savings. We're talking millions. Lost access to their savings, not because where they put the bank they put money with isn't FDIC insured, but the third party that was used between the front facing company that they thought was a bank and the real bank went bankrupt. Out of the 100,000 Americans who lost money, 80,000 of them were banking with Yoda. Yota, Yoda, Yoda. This is not even a laugh. Why am I? It's a serious issue. This is actually painful. So Yoda was this fintech financial technology company that offered prices for saving. So it was a positive reinforcement for saving. Amazing, wonderful objective, wonderful plan. Encourage saving by rewarding saving, and so a lot more people save. I can see that being an easy recommendation when we're talking about ways to save more and to encourage saving if you're a spend or if you're trying to save. Wonderful objective. Well, Yoda is a startup. Yoda is not a bank. But if they're going to encourage you saving, it means you depositing money with them, right? Well, they don't have bank accounts. They don't have the infrastructure to provide all that, the business of banking, the checking accounts, the savings account, the statements, the bookkeeping of it all. And so they partnered with Evolve Bank. Evolve Bank, it's FDIC insured, completely FDIC insured. If you look them up on FDIC.gov, completely FDIC insured. Well, Yoda needs to get this money to Evolve, and Yoda needs to have a way to keep track of each person. I mean, we're talking lots of people. They need to keep track of how much did you deposit, how much have you taken out, here's that, and this is your balance, and all that. And so, guess what? They hired a middleman called Synapse. Synapse took care of keeping track of getting money from you and moving it to Evolve. Well, May this year, Synapse went bankrupt. They can't tell right now who has what balance and where money is coming from, because Synapse did not only work with Yoda, they worked with a lot of other apps and fintechs, financial technology companies. And a lot of them had to do with managing finances, helping you save or helping you manage. One was for small businesses, helping small businesses manage their accounts, right? So it's not just Yoda, but most of it was Yoda. 80,000 of the 100,000 Americans were from Yoda. They were using Yoda service. There were others. Well, Synapse was in charge of getting money from all their customers all over the country. And now that they're bankrupt, they can't tell where money is coming and where money has gone and where money is and who sent what, who took what out, and who has the money left. And it's a mess. It's a mess. Now, of course, the customers are thinking, no, no, no. When I opened this account, I ensured it was FDIC insured. But when they took a look at the account, Evolve, the bank Yoda used, was FDIC insured, and Yoda advertised it was FDIC insured. Now, I cannot say if Yoda said they were FDIC insured, but based on customer statements, they saw Evolve Bank was FDIC insured and they figured all was insured. But here's what FDIC is saying: what has a problem is not a bank. And so therefore, there's no insurance. We're not covering this because the middleman, Synapses, that is what went bankrupt, and they are not a bank. Hence, therefore, they're not insured. Your money is not insured. As of this month, we're talking November, this happened in May, customers who had thousands saved with Yoda or who went through this apps or this fintechs who use Synapse as their middleman, they're telling them some are getting only $100 and something for thousands that they've saved. $100 and something for 200 and something thousand. One had proceeds from her house sales. She can't get that money. So far at this point, can't get that money. One, I think, was a teacher, principal, or whatnot, and the tuition money she has saved can't get it. And I feel so horrible for these guys because to me, where are regulators? This is where they come in because we average Joe don't know these things. And that's why I said, make sure the bank you're doing the service with, make sure they are FDIC insured. Because how are we to know this middleman situation? We are everyday folks. How are we supposed to know? I'm sure perhaps somewhere in the fine prints they let us know they were working with this middleman. But how are we supposed to know that they're not insured? Right? This is where we need regulation. If we're in 2024, we are in a day and age of technology. We need regulation to keep up and catch up. We can't have this fintechs open up and offer us the world and then not have any insurance for us. It's not our job to know the back end of their work. That's the regulator's job. Let's not go off on a tangent because this makes me so sad and angry at the same time because this is where our government steps in. This is where I'm pro regulation to the T because it is your job. I pay my taxes so you can cover our behind in these areas. Let's stick to the point. How can you protect yourself? Make sure if you're using those fintechs, those apps that promise to help you with budgeting, with saving, with managing your expenses, with all that, make sure if you're depositing your money with them that they have the insurance and your behind is covered. Do that, and hopefully, you never even have to thank me because you never have to deal with the consequences, right? Because you only remember this. Well, maybe you will thank me. Maybe something will happen in the future, and you go, "Whoo! Thank God for FDIC insurance," right? And you'll remember, "Thank God I verified." Do that, and you'll be. I think so far, as long as the government is good, then your money is good, even if anything goes wrong. Let's end on a good note. Let's end on a good note. What's a good note? Thanks for watching. I shouldn't laugh. I'm trying to find a good note so we don't leave this on a sad note. I feel so sorry for the 100,000 Americans because this is just ridiculous. And I hope this away, I don't know, I hope they get things sorted out and hopefully the government steps in with this. And if you're one of them, my heart bleeds for you. I am so sorry. I am so sorry. I pray it works out. It may delay, while they're sorting it out, but I pray eventually it gets sorted out. All right. For the rest of you, do due diligence. All right. Thank you for watching. I will see you in the next video.